Hello, this is John Smallwood, Certified Financial Planner, Senior Wealth Advisor at Smallwood Wealth Management. Today, we're going to continue on the conversation of talking about financial pressure. Every time we do these blogs, the focus, the intention is to identify financial pressure that is in your life. Financial pressure can positively help your financial plan or negatively impact your financial plan. Financial pressure, taxes, transaction costs, market volatility, planned obsolescence, technological change, inflation, etc., etc. Positive financial pressure, savings rate, interest, positive markets, inheritances, bonuses, cash flows, pensions, those are all positive things, okay? What I want to discuss is every time you're making a financial strategy, what you should be focused on is, does the financial strategy reduce my taxes today and in the future? Does it reduce the risk today and in the future? Do I reduce my fees today and in the future? Will it allow me to increase my savings rate, increase my retirement income, and pass more to my family? If it doesn't meet those criteria, it's not something that I think we want to do. It has to meet all of that criteria. Periodically, I'm coming back and looking at inflection points in the S&P 500. This is a chart from JP Morgan Chase that gets updated on a monthly basis. And we're now seeing that the market from the bottom of March 9th of 2009 is now upwards of 291% off the bottom. It was a little higher a couple months ago. We're now sitting here at 291% off the bottom. This is one of the longest sustained bull markets in the history of bull markets. Okay? You look back at previous great markets, we saw 100% uptick, 49% downturn through October 9th of 2002, 100% uptick, down 57%, and now 291% up. So what I thought would be helpful is to grab another chart that's been produced by First Trust very recently, March 29th, 2018. What we're focused on here is the history of the U.S. bear and bull market since 1926. The chart shows historical performance for the S&P 500 throughout the U.S. bull and bear markets from 1926 through March of 2018. The average bull market lasted 9 years with a cumulative return of 474%. The average bear market lasted 1.4 years with an average cumulative loss of 41%. So when you focus on the chart, bull market from the lowest close reached after the market has fallen 20% or more to the next market high. Bear market defined by from when the index closes at least 20% down from its previous high close through the lowest close reached after it's fallen 20% or more. So in blue, bull markets, in red, bear markets, and then in the pink down here, it's recessions. So what you're seeing is, if you look at this 3.7 years where the market went up 193%, the annualized return 34%, the total return 193%. Down 83%, annualized 2.8 years, 47%. Followed by an 815% rise, 13.9 years, with a 17% average rate of return. Followed by a very short 6 months of down 21%. Followed by a very long 15.1 years. And now, if we kind of move forward here from 1990 forward, we're now seeing we had two 44% downturns, a 50% downturn, and now we're 335%, according to this chart, 9.1 years. So the message of what I'm trying to discuss is that when the market hits these higher spots in history, potentially there's more risk. So one of the ideas, one of the focus points is we need to understand where your current risk level is. Are you prepared for the down market? Are your income sources in the right arrangement? Do you have the right buffers in place to protect against it? Are you prepared, is what we're asking. This information is information, right? And the key is, how do I apply the information? Do I ignore the information, or do I go back and do I look at my plan and make sure that my plan is structured properly so that if something were to occur, am I ready for it? Can I take advantage of the opportunity that presents? Because these are opportunities. Every time the market is down, they are opportunities. The question is, do I have any money available? Do I have a buffer? Will my retirement income be affected by it? Will I be able to benefit from these opportunities that are presented? Look forward to seeing you soon. Thanks for listening. Thanks for watching.
Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.